we've got the management of Ceigall Group. Now, they've been on a roll. This is a new company. Bhagat Singh, Group CFO at Ceigall, now joins in to talk to us about a recent contract where they've emerged as the lowest bidder. Mr. Singh, thank you very much for joining us this morning. We'll talk about a recent announcement that came from your company, which was on Wednesday, where you've emerged as the lowest bidder for orders worth 2,500 crores. You've reported that this is for construction of 2 4x6 lane bypasses in Uttar Pradesh on a hybrid annuity model. You want to share some more details about this contract? This is one of many that you've bagged in the road construction space in the recent few months. What is the timeline and the fact that you've emerged as the lowest bidder? What sort of pricing are you using here? Is this going to come in the cost of margins? Just give us a sense.
And thank you for inviting us here for a brief interaction about our company and the recent allotment of a tender. So I would like to inform you that finally Ceigall has been blessed with the 2 HAM contracts, and both are in Ayodhya. So these are the 2 HAM projects, HAM packages in southern and northern, and the company has been able to collect it in accordance with its envisaged EBITDA margins. So these are the 2 contracts wherein the time period is approximately 730 days, precisely 2 years, and the companies, we are expecting that the requisite land would be available in the next by the last quarter of this financial year or the first quarter of the next financial year, and the company would be able to commence the work and support its turnover accordingly.
Mr. Singh, let's talk payments. You will commence work next quarter. Is this milestone-based payments? When will we see the impact of this on your top line is what I specifically want to understand, and how will that be spread over the next 24, 36 months, however long this contract is for, the life of the order?
Okay, fine. I'll explain you how the model behaves. So in the HAM projects, first of all, when the land is available, 80% land is available. So the authority issues the appointed date to the concessionaire. So we are expecting the appointed date to be arrived at the last quarter of this financial year or the first quarter of the next financial year, 24-25. So once the appointed date is issued, we are expecting that against a total size, we would be able to achieve the 50% turnover in the first financial year and the remaining in the next financial year. And the requisite, as per the HAM contract, whatever equity is to be envisaged, 50% would be infused in the at the time of appointed date, issuance by an authority, and remaining would be issued in line with the disbursement requirement of the company. So obviously, these 2 HAM projects having a total aggregate value of close to 2,500 crore plus, they are going to support the top line of the company in a very substantial way. And likely in this financial year, if the project starts, the impact would be close to 300 to 400 crores. And if the project starts in the next financial year, 24-25, the total impact in the total aggregate turnover would be 1,000 crore plus.
Okay. Mr. Singh, how would you, good morning, Neeraj here. How would you,
good morning.
What would the nature of or the size of or the line of order wins be in times to come? Because we know that for the intermediate period of the election quarter, ordering, tendering, etc. had all taken a back seat. So what happens now and what happens as the monsoons end? Do you reckon that the pace of order flows and your probability of order wins could pick up in the next 3 to 4 months?
Yeah, certainly. We are expecting that in the next 2 quarters, there would be a good flow of the orders. And as we mentioned our earlier interactions also, that the Ceigall primarily focused towards central NHAI authorities order book, and we deals with the state government only if it is backed by ADB or a World Bank support. So we are expecting, the Ceigall has already bidded a total aggregate contract value of 12,000 crores, which are likely to open in the next 2 quarters, likely to be open. And we feel that in the next 2 quarters, there would be a good tendering opening, and it would be going to support the existing order book in a long way.
And you have a mix of EPC and HAM, right? If I'm not wrong, 12, 13 EPC, 4, 5 HAM projects. Are you
Correct.
Preferring one over the other based on the kind of orders that might be coming in? How is there a bifurcation that you can give?
Certainly, Neeraj, precisely the total HAM projects we are having against the total order book, the 40% of the order book is towards HAM and remaining is EPC. So if you ask me about the margin wise, so certainly the HAM projects are more profitable because in the HAM projects you get an EPC margin also, as well as there is a margin which lies in the SPV company also, which you can monetize either in the form of annuity for a 15 years period, or you can get a single inflow in the form of HAM sale to institutional investors. So the company priority is that whenever the bidding is there, our motto is very much clear, be it a EPC project or be it a HAM project. The company would like to achieve its envisaged EBITDA margin, which is a double-digit EBITDA margin, which the company is achieving from the last consistent many years. And we feel that whichever contract, be it a EPC, be it a HAM, whichever projects provide us that EBITDA, the company would be able to bid and will try to get it selected.
Say your order book split, how much comes from HAM and how much comes from EPC? And I know there's a very small portion of your order book that is towards airways, airport runways as well. Would you look to building that? It's only 1% from what I understand, but break that down, EPC, HAM and airport.
So if you ask me total, against the total order book, after the allotment of this two Ayodhya two HAM projects, our total order book would be close to 13,000 crores. So EPC would be 55%, 40% would be the HAM. Airport as of now is a very small portion, but yes, we are in the process of bidding for a new projects also. And as the motto of Ceigall is that we are a very well diversified company. We are bidding across all the verticals, be it railways, be it irrigation, be it solar, be it airport, and we are trying to make an educate basket, a good, probable, profitable basket across all the product lines so that they can contribute towards the revenue as well as the equivalent support to the margins.
Just one quick question, Mr. Singh, and this is just simply for our understanding as well. How do you manage working capital and cash flows? Because given the nature of some of these projects, they're fairly long-term in nature, and the payouts only happen in milestones. Where does your working capital day stand at? What is the debt on the books? Give us a little bit of an understanding to just get a sense of, how you do this and operate the business.
No, so I'll explain you the entire process. The first thing is we always maintain an adequate balance between the EPC and a HAM project. In EPC, whatever work you execute, you get a monthly collection from the authority. And since we are dealing with NHAI, so whatever work we execute, so there is no payment delays. We get a payment within a period of 20 to 30 days. It helps me to keep my working capital cycle reasonably at a low level. Now, when we talk about HAM projects, under the HAM project, 40% payment is given upfront during the construction period. Remaining 60% is we received from the authority in the 15 years period in the form of annuity. Now the question is how the company is able to manage the cash flows. So Ceigall India Limited, which is a parent company, precisely by virtue of its nature, it is an EPC company. So when we execute EPC work of NHAI directly, we get the collection from the NHAI. When we do the EPC work of the HAM project is allotted to Ceigall. Ceigall creates its SPV, which ultimately allots the EPC work to the Ceigall India, and we execute the EPC work. When we execute the EPC work of a HAM company, 40% payment is made by the authority to the SPV, and SPV remit the same to the Ceigall India. For the remaining 60%, the SPV take the disbursement because in the HAM project, 12 to 15% is equity, 40% is mobilization support from the authority, remaining is the term loan which the SPV avail for the purpose of disbursement to the concessionaire. So in case of an EPC company, Ceigall India Limited, there is no delay in the payment, be it the HAM project or EPC. We receive our payment as and when we submit the bill to the authority. Authority clears our bill within a period of 30 to 40 days. And as far as the HAM project is concerned, when we issue the bill to the SPV company makes the payment to the concessionaire, and the sources of funds for the SPV companies are two, basically either the mobilization support which they receive from the authority to the extent of 40%, over and above the 40%, the cash flow support to the SPV is in the form of disbursement which they avail from their term lenders and provide the liquidity to the concessionaire. So on an overall basis, a company, infra company, which has an adequate balance of EPC and HAM project, there is no cash flow issues. And since we are dealing primarily with the NHAI, so cash flow conversion is very fast, and we are maintaining only 15 to 17 days of inventory, 35 to 40 days of vendors, which ultimately help me to keep the overall working capital cycle between 30 to 35 days.
One final question, 4,200 over 3,000 odd in FY24. That's a very smart 40% uptake that you foresee in FY25. Do you anticipate similar pace of growth at your base for the next few years, or you can only give guidance for FY25 thus far? Is there an internal growth rate target for beyond FY25 as well?
See, Neeraj, the point is that the company is bidding according to the, as I mentioned, whatever projects are being available in the market for bidding. So company always bid across all the vertical, keeping in the margin. Yes, we always foresee that whatever the turnover we execute in a financial year, we always try to get 1.5 tons of the turnover executed from the authority during that year. So we try to build an order book of 4 to 5,000 crore every year, and which amounts to 15 to 20% growth on year-to-year basis. But yes, we always try to maintain an order book which provides certainty and visibility to the stakeholders for the next 3 to 4 years.
15 to 20% growth CAGR for the next 2-3 years can be ruled out.
Yes, so it is a conservative, yes.
Conservatively. Okay. Mr. Singh, we'll leave it at that. Thanks so much for taking the time out and speaking to us today. Really appreciate your time.